Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Her websites, jugglingdynamite.com and venablepark.com. Welcome back to the show, Danielle.
Hey, thanks, Jim.
Danielle, what are lumber and treasury yields telling us?
Well, lumber, of course, is at the forefront of this whole mania in the housing sector that we've seen over the past year. And housing starts at, record highs, and all the people that were moving out of cities to get away from COVID populations, I guess. And of course, the price of lumber, quadrupled basically in a matter of a year. So that added an enormous amount of cost, like about $50,000 on estimated cost to a new build in Canada of for example, 2,400 square foot house. So that helped to boost the price of housing. And now we see a bunch of things suggesting potentially that since about March, the frenzy seems to be coming off the boil. And I say that not just with respect to housing, but also with respect to financial speculation. So there's a lot of leading indicators that we're seeing that suggest that perhaps we've seen the peak in the crazy. And so interestingly, lumber prices have been falling again. In about the last 3 weeks, they're off about 25%. So, my point has been throughout that yes, there was a demand force at the base of this, but there was more speculation than there was actual demand for consumption. And there's been bottlenecks for sure. There's been some supply chain problems, rising to the leap in demand over the last year in many products. But that has to do more with an interim or a short-term issue with supply rather than any sort of long-term hindrance. And what we've seen, of course, with high prices in commodities, as we always do, is you get a leap in supply more than you get demand. In fact, the higher prices go, the more people look for substitutes and or decide to defer or not make that change or not consume because prices have gone up. So as demand starts to come down and supply comes up, and this is the point with the lockdown, of course, is, everyone's been talking about this big pent-up demand they expect as the economy reopens, and there's a bunch of problems with that. First of all, because the consumption of durable goods has been higher through the pandemic than before the pandemic. So we're talking about a 40% jump in just durable good orders in the first quarter, and that's some 20% higher than we saw in 2019 before the pandemic started. So this has been a very unusual recessionary period where, the government support has really buoyed consumption throughout. And so now we've got, all that unexpected, it came as a surprise to everyone because initially demand plunged, of course, in March of 20 when the economy shut down. But then, of course, with all the liquidity flooded into the system and free money handed out, we found that people were buying a lot of things, right? And these are big ticket items. But the problem is that once they consume these big ticket items, there's only so many home gyms and cars and pools that a household will buy, and then they just don't need anymore. And we've seen that in the data lately where each stimulus check that's sent out in the U.S., for example, in the first tranche in the spring of 20, people said that they had spent about 29% of the funds, and then the second tranche was something like 26, and then something like 24. So the bulk of the funds is going into saving, which includes debt repayment. So that trend is likely to continue. And, again, once everybody has that could buy houses at these crazy levels at record low rates has bought or has moved, there's not an infinite supply of new buyers able to achieve home ownership in these conditions. And, once you get the pendulum swing back to some work in the office and that sort of thing, we're already seeing that with the vaccination rates rising and more people being able to get out of the house, that, the consumption of goods is starting to fall off. So my point would be the inflationary pressures that everyone's been just going crazy talking about, predicting this is typical of current trends. People get out a ruler, draw a line straight up and say it's, never going to change, it's only going further. And we've been saying all along, wait a minute, this is a very unusual dynamic that we've got playing out here in terms of goods consumption. And yes, there's pent-up demand for services, but services are not the same thing. Like you will get a new haircut. Hopefully I will. My hair is almost to my waist at this point. It's like, I'd like to get a haircut hopefully sometime in July, but the point is I won't go back and get 3 more haircuts of the ones that I've missed, right? I'll just get the one. And the same goes with many other services. And then data has shown that many of the people say that they aren't going to go back to eating in restaurants as much because they've learned to cook at home. They've learned that it's an enjoyable experience for families to eat together. It's healthier, it's cheaper, et cetera, et cetera. So there's a bunch of reasons to think that the services will not rebound as much as people think. And even if they do, they're not likely to offset, as I say, this big consumption binge that was going on the goods side. And of course, commodities are used much less in services than they are in the goods side. So I think that we're heading into this disinflationary period now. I think it's already started. When we saw, for example, the U.S. And Canadian Treasury yields, they really peaked so far in about March. And, the 20-year Treasury yield peaked around the middle of March, and it's been coming down lately. The same goes with the 10-year Treasury in Canada and America. And that means that, that whole narrative around inflation's only going higher and interest rates are going to go higher and, bonds selling off, treasury selling off, that's stopped and reversed course in the last couple of months. And we're seeing that the flows are coming back in. The other major factor, so we've got these trends, as I'm talking about, that have been sort of anomalous during the pandemic, but we're falling back now to the main macro themes, right, which are debt is 40% higher than it was a year ago, believe it or not. Globally, debt is 40% higher. So, there's all this data that shows once you get debt to GDP over 250, you have a very deleterious effect on growth in the economy. So we've been seeing that now for the past decade and more, and now we've got even more of that. So the debt weight is larger. The demographics remain horrific in all the developed countries in the world, where the largest growing cohort of the population is the 65 plus. And people 65 plus, Jim, don't buy a lot of goods. The peak consumption years are it peaks about 54. And in terms of consumer goods, people over 65 consume about 25% less on average than people that are around their mid-50s. And, of course, the youngest people consume, under 25 consumes less than that, but every other age group consumes more. So as we get into our, late 50s and early 60s, our appetite or interest in goods is much lower. Yes, some interest in services, but again, there's a finite amount of spending that people want to do on that. So we've got the debt and demographics going back to the disinflation, deflation. We've got technology, which, by the way, has been invested in and accelerated greatly during the last year of the pandemic, where, businesses have invested a lot, and that has increased productivity at the most in the last decade, which is great, except that means there's less need for bringing back some of those workers, right? So companies have figured out how to do things with less workers, and that's not likely to reverse quickly. So technology is also a disinflationary effect that's reducing wages in the economy. And then we've got this fourth factor, which of course is QE. So, the central banks of the world went into bond buying and asset buying of mortgage-backed securities and all that in their sort of the fourth QE phase that they've done since the 2009 recession. They went in the last year. And of course, now as some of that rolls off and as they've had this big acceleration in the economy again, there's less reason or justification to continue doing QE. They're also running out of things to buy, quite honestly. And so what happens typically in these periods is when QE ends, you see bond prices, treasury prices, not corporate bonds, treasury prices rise. And that's meaning yields are falling again. So I think once you put all those four factors together, as the economy is almost fully reopened, but continues to reopen here in the next couple of months, I think the growth is going to be disappointing compared to what people are expecting, compared to what's priced into asset prices. And that's a disinflationary effect, which I think is going to translate into risk assets under compression. And we're already seeing quite a bit of that. You know, even just things like Bitcoin coming off 40% from its peak, and, you know, the IPO ETF is off about 30%, and the SPACs have come down about 36%, and Tesla's off about 40%, and even Canada's Shopify is off more than 30%. So all this has happened just in the past few months, and they were sort of the market darling leaders, this sort of leading edge of this mania around, insatiable inflation and that expectation of rising assets. So I think that we're likely into the next phase here. And when you get into when it's not rising inflation and it's not rising growth, you have stagnant growth and or falling growth and disinflation or deflation. During that era of the market cycle, it's not those tech leaders and things that are consumer discretionary that do great. It's more the fixed income treasury side, the U.S. dollar, which again, that's another factor here which has helped inflate commodity prices, has been the falling U.S. dollar. And of course, once the dollar starts to strengthen again, you get the opposite effect.
We'll have more with Danielle Park right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, China has stepped up their zero tolerance for commodity speculators and hoarders. What is that telling us?
Well, they have, we've seen this in past cycles. We saw this in 2007-8, and we saw it in 2011. A lot of the world spends a lot of its disposable income just to feed itself. In places like India, it's more than 30%. In places like China, when pork prices, et cetera, get really high, grains, it's very difficult for people who are spending, more than 25% of their disposable income on to eat. If prices escalate as much as they have, it starts to create great social unrest. And so it also inevitably on the industrial capacity side starts to suppress demand, as I was speaking of earlier. When prices get too high, it just starts to clamp down on the amount of products that people want to purchase. And so what you see is that that's bad for China's economy, right? They are very dependent. They only consume about 43% of their domestic consumption only drives about 43% of their domestic economy, and so they're really dependent on exports, and that means, industrial goods. So if they see commodity prices spiking too high, that starts to compress profit margins, it starts to suppress demand, and starts to suppress their economy overall. So what's happening right now is the same thing that's happened in the past two episodes like this, where as I've explained, the leap in commodity prices has very much been to do with financialization and speculators rather than demand. And we've seen that. We can track that in actual, what's been driving prices higher over the last year. And the bulk of it, just like with respect to financial assets like shares, the bulk of it has not been earnings growth or dividend growth. It's been expansion of the multiple paid. And it's the same kind of risk on trend or appetite has been reflected in commodity prices. And so there's a lot of funny stuff going on where, there's hoarding, there's stockpiling, there's futures trading, and that's largely it's done internationally, and it's often done, sort of off book, and it's not as easy for governments to track, and for regulators, it's very complex stuff. So China is just a place where they're starting to be concerned, the government's being concerned about their first quarter, their economy only expanded by 0.6%. And they're way off the growth trend that they saw even before the pandemic, never mind 10 years ago when they were growing their economy at 8% a year. So, they're concerned about this, this falling growth, falling, demand for their products, and the fact that food has become so expensive at home because they don't have, the bulk of the households there earn a fraction of the average household income in North America. So all these factors make it very dangerous for the existing government, and so they are now announcing everything they can to track down or squelch this impulse to speculate and gamble in hoard commodities. And so that's basically the motivation behind it. And at the margin, they will have an impact because they basically can arrest people. They can, take property. They can confiscate things. And so all of those sort of help to curb it to some extent, at least within the power or reach of the government. And it just, because it's a frenzy, because it's highly levered. A lot of people borrowed money to speculate and buy these assets. When they start, for example, controlling things like margin or cutting the amount of loans you can have on the books or on the system in order to do, quote, investing, all of that has an impact on dampening the animal spirits, and that starts to reverse the price trends. And they will ultimately be effective. All things together, all these factors that I'm describing together, will start to mean revert in general. And we're already seeing that in many of the commodity prices. So I think more of that to come.
In the energy business, it looks like people who want emission controls stiffened is really making a difference. ExxonMobil, or Mobil, I think it is Mobil. 2 independent directors were elected to the board despite the CEO spending millions to control the 12 seats on the board, and those people want the company to do more to control its emissions. And a Dutch court has ruled Shell must do more to combat emissions. What kind of messages are those moves sending?
Yeah, well, as a lawyer, I've been watching these cases quite closely. I think it's very interesting because the tack that's been taken here is on a human rights basis. So these are lawsuits that have been advanced on the grounds that the fossil fuel companies are breaching the human rights of residents with, negatively impacting their health. I think the other correlation that's been drawn here is the fact that the pandemic has been so disruptive and upsetting for so many people, but the reality that, climate change and runaway emissions are going to cause so much more havoc and harm, and it won't be fleeting. It won't be as easy as getting a shot in our arm to reverse the damage, right? Once we get to a certain point, and we may already be there, it's going to take decades and decades to recover any kind of normalcy in terms of their environmental conditions that you may have today. So I think a lot of people have become hyper-focused on the reality that all of these things are connected, right? Well, part of the the shortage of lumber in British Columbia, that has been part of the story of the lumber price, has to do with the pine beetle infestation that happened, and which that's partly to do with the fact that it doesn't get as cold in the winter. It doesn't kill off some of these plagues that happen. So and the food connection, the food system, as I've explained, about the pandemic and the speculation in commodities, but also just shortages of things in certain countries, droughts. All this stuff is really connected, and I think it's really heightened people's awareness of the fact that these concepts, people talk about their rights, but I always say, what rights do we have if we have no sustainable world around us? If our health is constantly damaged, or our liberties or ability to move in the world is so constrained because of these impacts. And I think all of that is really coming home to rational people, and they're seeing that, these companies doing business as usual, as if we're back 60, 70 years ago, is just not going to cut it. And so the Dutch court ruling found that they have to reduce their emissions 45% below 2019 levels by 2030. And this is the other thing. We used to talk about these concepts with these really long time frames, and people would think, by 2050, this and that. The data and the calculations, and again, this goes back to a lot of the technology advancements we've made just on the monitoring and the measuring side, have made it clear that we don't actually have 30, 40 more years to take really substantive steps here, and that it's what we're doing now and what we accomplish in the next 9 years is really critical in terms of how this all goes. And so there was that case. There was, 61% of Chevron's investors want to agreed that they want to actually reduce the sales of fossil fuels for the company. So, that's a shocker to people, because they think, wow, so the shareholders are saying that they're prepared to sell less. They're saying, yeah, we're prepared to sell less fossil fuels. Because again, back to the legal system. I always say the courts are the last line of defense. When the politicians are too, constrained by their business connections and constituents to actually legislate what's required, the courts are the last line of defense. So they're looking at it, the shareholders, aware shareholders are looking at it like, not only are we creating a massive problems that we could be sued for in terms of having to pay for cleanup and damages, and they're concerned. So board members are concerned about the liability. Shareholders that are thoughtful are concerned about the fact that this is a terrible long-term investment. And there really is so much, there's a bunch of discussion recently about, John Kerry said something recently about, well, we've only got about 50% of the technology we need to actually make this net zero transition, and that's just not true. And there was a lot of environmental experts, engineers, people that are in the space that have created all these solutions and products saying it's just not true that we don't have the solutions. We have about 95% of what we need to go net zero now. We just need the political will to do it, and the correct incentives in the system. So you're seeing this now on a board level, on a shareholder level, even on a regulatory level, like the International Energy Agency, of course. They're admitting that, that there should be no new exploration of infrastructure or pipelines or coal plants or any of that. There should be no spending on that. It should be phased out now, and certainly not by 2030. They literally put a hard line. They said by 2030 we shouldn't be spending any more money on this stuff, and globally by 2040. 2030 in developed countries, and globally by 2040. So you get, there's always this blowback that comes from places like Australia and Canada, because we're so heavily invested, sunk cost-wise, into these sectors, into this fossil fuel sector, and everyone wants to put their head in the sand and pretend that we can continue the way this is going, but we can't. So I think that the courts are going to continue to play a larger role, because we have human rights legislation, because we have things like the Charter, and what meaning are they for people if they can't breathe the air, and they can't go outside, and the temperatures are, impossible to grow food and to live. And there you have it.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. Her websites, jugglingdynamite.com and venablepark.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.